Hello everyone, Eric Wilson with ISO Health Incorporated. Hope you're having a fantastic day. Welcome to day 5 of our insurance training. Today is day 3 of life insurance for Life Insurance Awareness Week. Yesterday we talked about whole life, which as you found out I'm not the biggest fan of in most cases. And the day before we talked about term life, which is a true pure form of insurance. Today we're going to talk about universal life. Universal life has been out for quite many years. The first version of it didn't do so well. Then it came out as what was called universal life, which universal life was tied to the stock market, so you could lose money there. It was up and down. You got some good gains, some bad gains. Still has a death benefit, decent product, but pretty volatile. Third time was a charm. Third time, the product they have now is called Indexed Universal Life. Index plans are fabulous investments. Unlike the stock market where you can lose money, you can get stock market-like returns without the downside. This is one of my clients' Ameriprise, American Express Financial Advisor, whatever you want to call it, portfolios. Dated it's last year, it's from August 1st to September 30th of 2011. In that time frame, they went from August of 2011, August 1st, $176,866 to the end of September, $156,400. That is a loss of what, $20,000 in 60 days. Not a very good return, my friends. Pretty volatile. Your 401ks do the same thing up and down because they're in the market. What if I told you there was a way you could get stock market-like returns with ever losing a loss? When the market was down, you got just zero. Say going -3 or -10 or -20%, you just were flat for that year, for that month or that time frame. What if you could do that and never lose? What if I told you you could borrow against it to buy a car or to fund college or retirement fund? We call it tax-free retirement, but you can use it for college loans or student loans or buy a car. And here's the best part: you don't even necessarily have to pay the loan back if you choose not to. You're borrowing from yourself, and you can do it without having to pay it back. Two great books on the topic, by the way. One is by Brett Kitchen and Ethan Capps, called Safe Money Millionaire. You can see it there. Very good book there. And A Retirement Miracle by Patrick Kelly. Patrick Kelly also written a few other books there. I have a couple of these Retirement Miracles. If you'd like a copy, I have about 3 other copies for the first 3 people who email me. If you email me at isellhealth@gmail.com, I will give you a copy of this here for the first 3. By the way, today is September the 6th of 2012. They will probably be gone by this time tomorrow. But for the first 3 you call, I'll be happy to send you a copy. Email me with your name and address and where you live, and I'll be happy to send it to you. Now, here is, I showed you the 401k retirement plan someone had. Here's a retirement plan. I just picked a 35-year-old female. At retirement, if you start this at age 35, by the time you're 65, you're guaranteed a retirement of $78,000. This is based upon putting you $450 a month in your plan and doing it every single month and not borrowing it. But if you did that, you'd see a return of $78,121 a year in annual tax-free income. Tax-free income, okay? Nice thing. Now, if you started doing this when your child was 10 years old and you wanted to use it for a college funding part, in 8 years, you have $46,112 in the plan that you can use for borrowing against for college funding. If you did when your son was born, 18 years later, $173,000 in there. Just compound interest over time, building and building and building. The nice thing about these also is they're flexible. I'm self-employed. A lot of my clients are self-employed. What if you have a bad month, and you can't put $450 in it? You only have to put in this plan, the way this one here is designed, $78.20 minimum per month to keep the plan going. So you have to pay for the insurance to keep the plan active. So if you had a really bad month, you can just put $78.20 in the plan. The plan keeps going. Now, of course, you're not going to get to see all the returns if you do that every month. You won't see the $78,000 return. You want all college funding, but it's a viable option. It's a nice thing you can do. Of course, if you borrow against for college and you choose not to pay it back, that's okay. But you also won't see the $78,000 in your retirement unless you do. So it's a really nice plan, and it goes on forever. I mean, I have this thing designed up to age 120, with a guy making $78,121 per year. Now, how is that possible? The IRS has some really nice tax laws that are favorable for this plan. The 7702A plan, which is what basically is based upon, basically gives you tax-free accumulation within a life insurance policy. 72E gives you a tax-free distribution on a life insurance policy, and 101A is the tax-free death benefit, which most people already know about. But the nice thing about this is the death benefit. Oh, also I said you set this up with a minimum. If you're going to do it for an investment purpose, you set up with a minimum death benefit and increase it over time. That builds your cash quicker. With this particular plan, it starts out in year one for a 35-year-old female with a death benefit of $216,000. But by the time the person is 64, the death benefit is $753,000. So you just see it builds over time, and then when you start tapping into the money and start taking money off of it, by the time you're 74, the death benefit's down to 278, and so forth and so on. But it's a fantastic idea, great way to do retirement. You'll never lose money in it. It's a safe money product, hence the name Safe Money Millionaire or Retirement Miracle. It is a miracle that you can retire tax-free. That's all I have. If you have any questions, I'm happy to answer them by email, isellhealth@gmail.com, or you can call me toll-free at 888-448-5370. Hope you have a fantastic day. That, for the most part, concludes our life insurance training over the next couple of days. I am going to talk a little bit about annuities, which kind of falls in, which is not really a life insurance product per se, but does have a death benefit. So we're going to talk about that later, but probably not this week. Tomorrow's Friday. We're going to take Friday off again like we did last week, and I'll see you next week. Thank you.